All right, so good afternoon, everyone. Welcome to the May Diet edition of our lecture. Please mute your mic, mute your mic, mute your mic. If you can hear me, please, thumbs ups again. Let's have these emojis. Okay, right. Thank you so much. Thank you so much. And so, just to set the rules straight, I want to plead with every one of us to please, as much as we can, avoid any kind of noise. As much as we can, stick to the rules. You have any questions? Before I ask you to ask question, just write it. Use the message tab on this call. Just write your questions there. I will answer you. It's too early, Mary, for you to raise your hand. I wouldn't know what is the issue, but just hold on. Whatever it is, we're going to attend to it. Is that taken? That being said, I'm sure a lot of us we've had time. Some of us we are coming back to write FR. Some of us we have never written FR before, and then it's our first time as it were. So financial reporting is like I've always tell the students in the past diets, is one of the most simplest course that you don't need to bother yourself much about because it's something that you can pass. All that you need is to align with whatever we are telling you. And I believe at the end of the day, the sky will be the limit. So quickly, what are we to consider this May diet, as it were? I can, have what we call the grid. When we talk about the grid, that is exactly what you have to cover. That is what we will be looking at very quickly. I can FR syllabus in brief. I'm sure you can see the screen clearly. So this is what is expected of us, what we have to look at in this particular diet. This is the syllabus overview. So we have A to G as the grid. In other words, you have to cover all of these 100%, so to say. And then when you are done, you can go and write the exams. But I want to tell you that you cannot cover it all. And that's certain, you cannot cover it all. And mine is to give you the basic guide, what will help you, what will enable you and enhance you, and then what will help you to be solid when you go in there to write your exam. So we have grid A, B, C, D. A has to do with the conceptual and the regulatory framework. And you can see the width here. The width is 10%. In other words, it means that there is no way you will go to the exams, writing our FR exams, that you will not see any of these questions coming from conceptual and regulatory framework, and the weight is 10%. And I keep telling students, a lot of us we joke with this A, we concentrate on B, on C, on D, as well as E, and then we forget about A, F, and G. And I want to tell you that there is no way that you will pass this ICANN exam without putting a lot of attention on the grid A, F, and G. So please, I will want to beg every one of us to pay attention to that grid A. Today we shall be concentrating on looking at this grid A. The grid B has to do with accounting standard policies, accounting standards, the normal standard that you know. And then the C has to do with preparation and presentation of single entity general purpose financial statement. What this one simply means is a group account. This other group B has to do with the publish account. Why? The C has to do with B has to do with standards, C has to do with publish account, D has to do with group account, and he has to do with ratio analysis, and then you have sustainability report, and then G, ethics, current technological development, financial reporting. So that is that for that. Please, I want to implore us to pay attention to whatever we are doing, and then the sky will be our limit. So quickly, let's go to what we have to do today. My rules are very simple, and I'm begging you to stick to it. The rules are very, very simple. And I will beg you again, stick to it. What are the rules? When you are coming to the class, just come with a jotting note. Don't think that you will know it all. Come with a pad, what you will write with, and a pen. Come with your calculator. That's very, very important. Come with your calculator. I'm begging you, please. And then, as much as possible, pay attention. Pay attention, please. Pay attention. So that is that for that. So now, what do we have to look at today? Like I said, Rashidat also, please, you can mute your video. I'm not here to see your face. Some people are looking at your face and they will be distracted. I don't want you to distract my student. Your beautiful face, mute it. Huh? So you mute your. You want me to help you mute it? Okay, so let's go. We are today looking at the conceptual framework and the regulatory framework, the conceptual framework, substance over form, basis of accounting, and the core principles. We have to finish this module today. And once we are done, you should be rest assured that you are done with 10% of what you are to look at for the diet. What is the regulatory framework talking about? Literally, you understand that there is this saying that where there are no rules, there can be no sin. You agree with me, right? Where there are no rules, there can be no sin. And that is why we are looking at this regulatory framework. Where there are no rules, there will be no sin. So the concept of regulatory framework, is telling us about the entire, framework and systems, the pronouncements, institution, the guidelines, all the basics that governs how financial statements are to be prepared, are to be presented, as well as how they should be interpreted. Please take note of that. Nobody will ask you what is a regulatory framework, but just know the overview, the context. What is it all about? Like the name sounds, it is a framework. It is a framework. So regulatory framework talks about the entire systems of law, the standards, all these pronouncements, guidelines that governs how we should prepare and present financial statement. It also tells us how we should audit, how we should interpret the financial statement. So in the overall, when we talk about financial reporting, it is more or less like you are reporting your an entity's performance, an entity's obligation, as it were, in a single document. So financial reporting, as it were, consists of you telling the members of the public, this is what I have done, throughout this period of time. Usually, let's assume, between January to December, a calendar year. This is what I have done. That's what we call financial reporting. But without due regulations, for instance, we can just do whatever we want to do in the report and send it across to the public. But that is not what is expected of the professional. So that is that for that. So what are the key environment via which regulations are based? Number one, what I mean by key elements on which the financial regulation are based, I'm talking about the structure, the environments as to which financial report actually do exist on. I'm talking about what are the core traits, core characteristics, what you can actually see that a financial report should represent. And number one is any information that you are giving us in your financial report should be reliable. In other words, I should be able to rely on it to make an informed decision. You understand now? Number two, it must be comparable. I must be able to compare whatever report you are giving to me over the time. And number 3, it must be transparent enough. Very, very important for us to understand. Must be transparent enough. And number 4, it must be useful for economical decision making. So that is very, very important for us to take note of. And that having said all of these, what exactly are the objective of reporting regulations? That is the importance. Why do we need to regulate financial reporting? Or why do preparer, presenter, auditors, interpreter of financial statement, why do they need to be guided? Why do they need to be regulated? Number 1, it is to protect the investors. Very, very important. To protect the investors. There is no way I can put, my capital, my funds into an entity without being assured that I will get return back. And one way that the investor will know that the return is coming back is through financial report. So without adequate financial report, there is no way an investor will feel protected. So you should understand that the first thing first is with regulation, investors, stakeholders, are duly protected. Number 2, it promotes what we call uniformity in the practice of accounting. You understand me now? Uniformity. In other words, it does not give any lag. It does not give any lapse. It allows preparer to practice the same thing. What you are doing in Makurdi is what I'm doing in Abuja. What I'm doing in Abuja is what other persons are doing in Port Harcourt. So it promotes that uniformity. That is that for that. And then number 3, it prevents what we call creative accounting and window dressing. Creative accounting means practicing what is not applicable. You understand me now? Practicing what is not applicable. In other words, a lot of persons, they will just be doing whatever they like, and like that and like that. So I don't want to go into the details. We'll still look at this creative accounting in our subsequent classes. So just know that it prevents it. And then number 4, it enhances what we call confidence, in the users as well as the capital market individuals. There are a lot of users, a lot of them. And so it really enhances their confidence in the report that is being presented to the public. And then number 5, it supports what we call the economic growth, and it also supports accountability. Please, these things that I've mentioned, they are things that you have at the back of your mind. Let it be a takeaway from this lecture. It's been a long time. I can actually ask questions on this. And so they can decide to ask you this diet. Importance of regulation. Why do you think preparer, presenter, auditors of financial statements should be regulated? These are the key reasons. Remember, I said it prevents creative accounting. Number 1, it allows for uniformities. Number 2, it allows for uniformity. Number 3, it allows for comparability. You don't need to know, those statements. Just know the keywords: uniformity, comparability, preventive of creative accounting, enhancing of confidence, support economic growth. Those are the keywords that you need to know. Also, let me state this: as you are reading, you can't have all the time to be putting everything. Don't cram. Just know the keywords. That's how to understand. Know the keywords, and then frame the questions for yourself. Ask questions by yourself. That's how to deal with all of this. And that is that for that. So quickly, what are the sources of regulations in Nigeria? Of sources of regulations across board. That is, who regulates. We have looked at the overview, the importance. Now, who are those that are the regulators? So we have about 4 or 5 layers of regulators. We have sources of regulation. We have the International Financial Reporting Standard, that is the accounting standards. These are the key ones. These are the key guide, the key instructors of how financial statement should be prepared. They tell us the basicity, what exactly we should align ourselves to when we are preparing financial statement. So we have the International Financial Reporting Standard, which we usually call the IFRS. It used to be known as International Accounting Standard, IAS, but now we refer to it as IFRS. So it is an authoritative guidelines for how financial report should be prepared and presented. And then the body that sets this standard is known as the International Accounting Standard Board. International Accounting Standard Board. So we have various relevant standards under the ICANN financial reporting mechanism. Various key standards that you and I we must familiar ourselves with. Very, very important. Very, very important. We have the IS1. The IS1 talks about the presentation of financial statement, how you should present it. We have IS8, which talks about accounting policies, changing accounting policies, as well as errors. We have IS10, event after reporting period. IS16 is there, PPE, that's property, plant, and equipment. IFRS 9, IS32 talks about financial instruments. We have IFRS 15, revenue from contract with customer. It used to be IS 15, and then it has been refreshed to IFRS 15. That's been repealed. And we have IFRS 16 that talks about lease contract. It used to be IS 16. It has also been reviewed. And we have IS 33 that talks about earnings per share, that is EPS. IFRS 5 is also there that talks about non-current asset held for sale. We have IS 40 that talks about investment property, IS 38 that talks about intangible assets. We have quite a number of them that you have to be familiar with as an accountant, as a professional. And that is the essence of why you are in this class. In our next subsequent classes, we shall be looking at most of these standards. And I believe at the end of the day, you will be well grounded that once you pick up any particular information or ledger, it will be seamless for you to prepare and present a solid financial report. And so that's that for that. These are some of the standards. I just have to bring them up so that you can see it. And then we have the standard setting bodies and how the standard itself are being set. The standard setting bodies in Nigeria, in the whole wide world, are the International Accounting Standard Board. Very, very important that you should know what they are to do. The AISB, for instance, they are the standard setter responsible for development and issuing the National Financial Reporting Standard. I've said that before. They came into being in the year 2021, and then they replaced what we used to have as a International Accounting Standard Committee. All of these ones are just stories. You can read them in your material. And then we have another layer that is called the Financial Reporting Council of Nigeria. They also join in setting some of these standards. And then we have the International Federation of Accountants. They also join in setting these standards. And you have quite a number of them. They're all in the material. You don't need to bother yourself about them. They can be asking you for the bodies that set this standard. But what is important for you to know is the process of how they set the standard. That process, very, very important. Very, very important. I may be a little bit fast because not too fast, but I will be telling you the key things that you need to know. Just be taking notes. What are the standard setting process? How is standard being set? When we talk about standard, like I said, there are the guidelines, the authoritative guidelines for accountant, what accountant must follow in how to prepare and present financial statements. And I've told you we have quite a number of them. I think we have about 20-something IFRSs and about 30-something IASs, as it were. And you also have even the local standards in Nigeria, for instance, the SAS, which are still applicable for SMEs, applicable for some part of petroleum financial reporting. So all of these ones, they are basic guidelines. That's why we call them standards as to what we are to align ourselves with them when we are preparing and presenting a financial statement. So how are standards being set? You can be asked in your exam. Please take note. Always note the one I keep saying you can be asked in your exam and jot it down. How are standards being set? Number one, you identify the issue. You identify the issue. What exactly are we to address? What are the emerging problems? That is number one. Number two, you do some research and then discussions. You know, you do research. What can we do about this? What exactly do you think we should do? And then once you have done your research, you come up what we call a discussion paper. You draft what we call a discussion paper. You circulate it across all the professional bodies around the world to seek for their input. You understand? Now, when this the report comes back to you, that is what we call discussion paper. Once it comes back to the body that is setting, like I told you earlier, the body that is setting it majorly is the International Accounting Standard Board. They are the one that is to identify any issue. They are the one that is to also issue what we call a discussion paper, circulating it across the professionals in the whole world. When they circulate it, the information that is the feedback they get will determine if they will proceed or if they will not proceed. And if they are to proceed, the third step will be to issue what we call a draft, exposure draft. In other words, if they consider it that there is a need for also, proceed with coming up with a standard, they will draft what we call exposure draft. That is a proposed standard or a part of a standard that should be amended. A part of a standard that should be amended. For instance, the IS1 has been in existence for a very long time. And I think about 4 years ago, a portion of the standard was looked into in terms of presentation and disclosure. And at the end of the day, an exposure draft was raised. And when exposure draft was raised, it came back to the body, that is the International Standard Board, that they should proceed and in reviewing the IS1, and that is what gave rise to IFRS 18, which will come to full use by 1st of January 2027. So I'm just giving that as an example, so you should know how these standards are being set. So number one, I said identify an issue. Number two, do a research and come up with what we call a discussion paper. The feedback from the discussion paper will be either you are going to go ahead or you will not go ahead. But if you have the reason to go ahead, the next step to take is to issue what we call an exposure draft. An exposure draft. Please take note. An exposure draft is just like the standard is what the standard will look like, or what the amendment to the standard will look like. And then you circulate it across again to all the professionals. Look at it too. This is what the draft, this is what the standard will look like. Are we okay with it? Should we remove something? Should we add something to it? And then that is where the step 4 comes into play. Public consultation. You speak with the stakeholders, auditors, accountants, regulators, companies, everybody in the public. You just want to hear their views. And then you review the draft exposure and then redraft it. And after that, you issue a final standards. And after that, you implement and enforce usage. So there are basically 7 steps, but you don't need to know all the 7 steps. All that you need to know, very importantly, is number 1, that there is an issue. You identify the issue. Very, very important. Identifying the issue. Number 2, the key ones, that's what I'm telling you now. If you cannot remember everything, but always start with identification of the issue. Are we to issue new standards or amend the current standard? Number 2, you issue what we call an exposure draft. Very, very important. Exposure draft to get a feedback. That's number 2. Very, very important for you to know. And then number 3 is to issue out what we call the draft itself. Draft itself. Please don't forget. Let me go back to that place now. Sorry, I missed a step. Let me take it again. The key things that you have to know. Number 1, identify the issue. Number 2, raise a discussion paper. In other words, what is the professional opinion about this? You understand? That's discussion paper. Number 3, exposure draft, raise the exposure draft. You understand? Now that exposure draft, you know, takes care of what will happen in step 4 and step 5. So you may necessarily not talk about step 4 and step 5 because you can explain it under step 3. Once you issue an exposure draft, what you are simply doing is to seek public opinion. What are the regulators saying? The companies, the investors, the end users. What do you think about this? And then it is from what the feedback you get from what they say that we tell you whether you are proceeding or you are not proceeding. And if you are proceeding, just go straight to issuing the final standard. Let the people see that, okay, this is the standard or this is the amendment to the standard. And that's step 4. And then step 5, you implement and enforce usage. So 5 key things that you need to know. Let me go over it again. Number 1 is that you must identify the issue. Very, very important. You must identify the issue. Number 2, raise what we call the discussion paper. That is seeking opinions. Do research. Is this necessary? Should we amend? Should we not amend? And number 3, raise an exposure draft. And number 4, issue the standard. If you feel that we should go ahead and issue a new standard or amend a new standard, go ahead and issue it. And then number 5, enforce usage. That is the standard setting process. Please take note of what I have just said. And that is the key things that that we need to know. Now let's look at this question. I think it's question 3. Question 3 of May, either May or November 2021 FR question. Look at this. Outline the main steps involved in development of an accounting standard by IASB. Remember what I have just said. It's very, very simple. This question has 3 marks. This particular question, I saw it, it has 3 marks. If this is what you can do first in your exam, just go and attack it. Go and do attack it. 3 marks minus 50. You have 47 that you are looking out for. So you outline the main steps. What are the steps? I just mentioned them now. Who can quickly help us to identify that steps? Very quickly, who can help us? Just raise your hand and then I will call you.
Hello, sir.
All right, Afolabi, for me, go ahead.
Okay. First one is identification of issues.
Okay.
Can you hear me?
I can hear you clearly. Go ahead.
Okay, first one is identification of issues. Second one, research and discussion. Raise a discussion paper. That's a good one. Third one, exposure drafts. Fourth one, public consultation.
Okay.
Then fifth one, review and redrafting. You said we should take note of 5 now.
Okay, review and what?
Redrafting.
And then you redraft. You review and then you okay, you have tried. Please let me clap for her. At least I'll give you half mark. Frank, go ahead. You can mute your mic, Afolabi. Thank you, and put down your hands. Frank, you can go ahead. Intega, Frank, go ahead, please. All right, and Frank is not here. Let's call on Aye Mary Daniel. Please go ahead.
Okay, thank you, sir. So the first steps is to identification of issue. So we have to recognize that there's an issue that needs to be improved upon. So the second step is research and discussion paper. So whereby you issue out a paper for the public opinion, so that you're able to get more information about it. So the step 3 is exposure draft preparation. You have to prepare your draft based on the research you were able to, based on the information you were able to get from the research. So, and after that, step 4, I think you issuance of final standard. then before implementation and enforcement. Thank you, sir.
Thank you so much. Let me clap for Ayemere Daniel. Yeah, thank you so much, Ayemere. That's very, very wonderful of you. You don't need to know the 7 steps. The key things that examiner or markers are looking out for are issue, discussion paper, exposure draft, the final standard, implementation. If that is all you know, that's all. My God, at the top. Then you are done. 3 marks, you put it there. Now, before I proceed now, let me also tell you how to get marks. Now, once you check a question and they write 3 marks there, 3 marks, don't waste much time. Just the 5 things, these 5 steps that we have mentioned, you can put it there. But let's assume that they ask this question and they say 7 marks. Don't just mention the way we have. You can go ahead and do it. That 7, the way I mentioned it earlier, that 7 steps that I mentioned, you can do it that way. You say there's identify an issue. Number 2, raise a discussion paper. Number 3, raise a exposure draft. Number 4, seek for public opinion. Number 5, get feedback. Number 6, raise standard. Number 7, enforce and implement. That's how to do it. And don't module it together. Don't write everything. Put them in bullets. Put them in bullets. Once the marker see that you have done number 1 correctly, it will mark you the second one. And that's how to get your mark fully. You understand now? Please take note of what I've said. Put it in your left hand. And that is that for that. Afolabi, you are still raising your hand. Any issue? If you know you are not, just put down everybody put down your hands so that we can go far. Thank you so much. Let's go ahead and look at, we are still under the regulators. And then I've just talked about, the International Accounting Standard Board issuing out accounting standard. This is the sources of regulation. That's where we are. Remember, your question can come in this way under these regulators. They can ask you who are the people that are mentioned the regulators, and they can ask you what are the sources of regulation. You understand? That's why I'm combining 2 things at a time. The first one, as I said, source of regulation is the accounting standard. The regulator is the International Accounting Standard Board. That is number 1. And then the second source that we are going to be looking at is the Company and Allied Matter Act of 2020. Company and Allied Matter Act of 2020. And the regulator are the Corporate Affairs Commission of Nigeria. The Corporate Affairs Commission, they are the one that regulate the Company and Allied Matter Act. Please take note. You can be asked. That's why I'm telling you this now. Also, the Financial Reporting Council of Nigeria, they also regulate the Company and Allied Matter Act for accountants. We'll get there. So now, the Company and Allied Matter Act is a legal foundation for how financial report is to be made in Nigeria. You know, they tell us the forms, the contents of the financial statement. For instance, a company is expected to present its statement of financial position, statement of profit or loss, as well as the cash flow. They tell us the statement. And then they tell us what are the director's responsibility. They tell us auditors' requirements and a lot of other things. So quickly, we have quite a number of sections that, talks about a lot of things that accountants are to be familiar with. You will do yourself well to know most of these things. For instance, we have section 74 that tells us that every company must keep a financial record. And these records that you are keeping, you cannot discard them. You must keep them in a place for at least minimum of 7 years before you can discard them. Very, very important. Section 375 talks about the duties of the directors in preparing the financial statement. It tells us that the directors of every company are responsible for the preparing of financial statements for each of the financial year and a whole lot of other things there. Then we have section 376 that talks about the forms and the content of financial statement. In other words, it tells us that every financial statement accordingly in Nigeria must be presented in English language, and then it must be presented in Nigerian currency. We expect that Every preparer must comply to this. Then Section 377 talks about the true and fairness in presenting those information on the financial statement. Section 378 talks about the component of a financial statement. It talks about a full set of financial statements. I just mentioned them not quite long ago. And then 379 talks about the annual financial statement. That is, you must prepare and lay before an annual general meeting the financial statement of the preceding year. That is, the financial year where you have made dealings. That is talking about the director. 380 talks about approval and signature of financial statement. In other words, the shareholders, the directors, they must be the people that must sign and approve that a financial statement is useful and can be audited. Without them signing, you cannot in any way consider them as a financial statement. So, as an accountant that you have prepared, the management account does not translate that it is what can be used and authorized as for public to consume. So, until the director sign it, it is not in any way an authorized document of an entity. So take note of that. And then when we're talking about company, we're not talking about people that are registered with CAC using business name. We're talking about people. We're talking about companies that are limited, that have limited liability structure. For instance, I've been hearing a lot of persons say that Shebi have registered business name with CAC. I'm a company. That's not true. That's not the company. You are just a sole proprietor, a sole trader, as it were, recognized under CAC as a sole trader. You are carrying on business of a one-man business, as it were. So please take note of that. So when we're talking about the company in Nigeria, we're talking about the small, medium, and enterprises that are registered as a liability company or as trustees, as it were, with a CAC. So these are the basic guidelines. So you must be familiar with certain requirements, majorly the director's responsibility. Please know those things. The director's responsibility, the content of director's responsibility, according to the section of the Common Law Matter Act. So do yourself well to get these notes. They are well detailed there, and then you can read more of them. So you have a lot of them, a lot of the sections of the standards of the Common Law Matter Act in this particular material. There you have the Financial Reporting Council of Nigeria as the third source of regulation. The Financial Reporting Council of Nigeria as the third source of regulation. They are actually the organ that is recognized by law in Nigeria that governs, the accountants, the auditor, the actuaries, the valuers, and the financial reporters in Nigeria. They are established by an act in the year 2011, and then they are the one that enforce, and they are the one that also can sanction any accountant when they err. So the Financial Reporting Council of Nigeria, they are also a source of regulations. There are sections of the law that state quite a number of things that you and I as a professional must always adhere to and comply with. And then we'll do ourselves good also to know quite a number of these. Section 8, for instance, talks about the fact that the council has the power, to adopt, to issue accounting and financial reporting standards. In other words, they are the one that will tell us that whether ISB issue standard, though, they are the one that will tell us that, oh yeah, start using it, and this is how to use it. For instance, IFRS 18 has been issued by ISB, but then it has not been in use in Nigeria, as it were. ICANN, of course, have been telling us, okay, let's get ourselves familiar with the content and the context, which is what we have been doing. But then until FRC tells accountants, oh yeah, use this, you cannot use it. For instance, we also have an issue, I think last year or so, where our inflation, was it last year or the year before, where our inflation rose to about 38%. And so logically, when we have that kind of situation, it is either we are in an hyperinflationary period or not, and then FRSM will be the one to tell us, okay, if we are in hyperinflationary moment, These are the standards that we are to use. You understand? So they have specific roles that they play, and you need to know them. And again, let me mention that they have the power to sanction. That's that. Because you can also be asked this question. What are the major roles of FRCN? Please, number one, like I said, they are to tell us the standards that we are to apply as an accountant. Number two, they can enforce sanctions. Very, very important. Please take note. They can enforce sanction. They can enforce sanction. And number three, they can, ensure that auditors comply, with the standards of the council. That is, the Financial Reporting Council of Nigeria ensures that the auditors, they comply with whatever it is that the council is stating. In other words, auditors should not do anyhow and present stuffs anyhow. They are being guided by the Financial Reporting Council of Nigeria. Guidelines. So take note of that. We have quite a number of them. Getting acquainted with them, that will help us a lot. The number 4 source of regulation in Nigeria. Been recognized by law under the law of the Federation of 2004. And then they regulate mainly the training, examination, admission, and the discipline of chartered accountants in Nigeria. They also issue what we call the ethical standards. And then you have the codes of ethics for professional accountants. We have about 5 core of them. We are guided by all of these ethics and principles. And when we talk about the code of ethics, as professional accountants, these are the minimum expectation from you to your clients and members of the public. Members of the public, this is what we expect that you should do as a professional accountant. Number one, this is whether that what you must imbibe includes having what we call a high level of integrity. Very important. As an accountant, you must have integrity. Number two, you must have the professional competence. That's why you are in this class. You must be competent enough to handle whatever you are handling. And number three, we have confidentiality. Every information presented to you must keep it with utmost confidence. Not that because you have access to the salary of your co-workers, you begin to tell people and members of the public. That's wrong. And that's where confidentiality comes to play. And then professional behavior. It is a set of you that as a professional, you must behave professionally. And then number 5, objectivity. You must be objective. In whatever you are doing, you must not be biased. So those are the key core, the cause of the code of ethics. And then this particular code of ethics, I have an acronym for it. I call it COPI. COPI, COPPI, copy or copy, whatever it is. Just let it be ringing in your head. You can be asked, what are the principles of a professional accountant? You can also be asked, what are the code of ethics of professional accountant? Just know that the answer is a copy. Very, very simple. Don't forget, keep it in your left hand. And so that is the third source of regulation. We also have quite a number of other sources, and that is industry regulations. They are called and to be known as guidelines. We have the CBN regulations, NICOM, PENCOM. NICOM is insurance, PENCOM has to do with pension, and we have the Stock Exchange Commission. They also issues guidelines. So what the regulation that they issues are known as guidelines. You understand? They guide accountants as to what is expected of them. You understand? So all of these are sources of regulations in Nigeria. Remember, we have mentioned quite a number. So let me recap very quickly: sources of regulations and their regulators. We have the accounting standard, and they are being regulated by International Accounting Standard Board, and then FRC for Nigeria. And then we have the second source of regulations to be Federal Reporting Council of Nigeria, sections. Is an act that is a law in Nigeria, and they have quite a number of sections. All of those sections, they guide Nigerians, or they guide professional accountants. They guide and regulate what we do, what we prepare, what we present. And then the regulator is the Federal Reporting Council of Nigeria, as it were, as the name sounds. And then we have the third one, which is the professional bodies. And we have ICANN, ANAN, CIBN, a lot of them. But we mirror ourselves to ICANN. And I told you that ICANN is set up by an act of Parliament, the Law of Federation of Nigeria of 2004. And then theirs is to ensure that whoever is going to be a chartered accountant under the institute must pass through their examination. They must admit the person, and then they must license the person adequately well. They also give what we call ethical guidelines. That is, what a professional, the minimum guidelines for a professional, the code, the ethics, the ethical minimum standards that a professional must uphold discharging his duty. And we talk about the fact that they must be the confidentiality must be top notch, the objectivity must be top notch, professionalism must be top notch, the professional behavior very important, competence, professional competence very important, and then quite a number of the we talk about their integrity, very, very important also. And then we talk about another regulator, which we a source of regulation, which is the industry where we operate. All the professional accountants operate in different industries in Nigeria, for instance. Well, those that are in the banking sector, those that are in manufacturing sectors, all of such. We have guidelines that have been issued part A of this particular class. I took my time to explain a lot to us under this regulatory framework, because it's been a while they ask questions from there, and that's why I took my time. Don't think that I'm just talking and talking. Be picking something, please. That is that for that. Any questions, please, before we go ahead?
Hello.
Right.
Good afternoon.
Good afternoon. Go ahead.
Please, I want to ask if this class is being recorded.
Yes, it's being recorded. The class is being fully recorded. So let's take questions. If there are no questions from students, look at this question. They said a listed Nigerian entity prepares financial statement using UK GAAP, claiming its foreign investors prefer this. Require provide a professional advice to these clients. Assuming the answer is not here now, what would be your answer? Can anybody attempt it? Just raise your hand, we'll call you. Do you understand the question? Now look at it. They said a listed Nigerian entity prepares financial statement using UK GAAP, claiming its foreign investors prefer it. As a professional accountant, you are asked to advise this client. What will you tell the client based on what we have said so far? The first thing that must come to your mind is, are we using UK GAAP in Nigeria? Okay, Oyinda Amola, go ahead.
According to the CAMA 2020, it said there is a forms and contents for preparing financial statements. So I don't think we are allowed to use UK GAAP.
Let me clap for her. Oyinda Amola, I'm giving you 1 mark. That's a very logical thinking. And that's how to always answer questions. Now, all of us cannot answer the same way, but have the basic understanding. How, for instance, can you use a UK gap in Nigeria because your investors prefer it? You understand? It's not possible. CAMA says that you must prepare your account in English language using Nigerian currency. Is that also? That's what CAMA said. And CAMA also stated in its form and its content that you have to prepare your account in line with provisions of what the FRC has given to us as guidelines. So there is no way you can use the UK gap. So you have to advise the client professional that this is not tenable and possible in Nigeria for a company that is operating in Nigeria. So that is that for that. So a lot of questions are in this material. You can get it after this class. Like I told us yesterday when we were doing the orientation, you can always get the material. I think it's just for 3,500 and it's explicit. A lot of questions are there. It will guide us adequately. So let's really go to the next part of our lecture, and that's talking about the conceptual framework for financial reporting. Remember, the grid A talks about regulatory and conceptual framework. So we are done with the part A. We are now in the part B, conceptual framework. What is conceptual framework? Conceptual framework is not a standard. It is more or less like a fundamental concept or a guideline, that an accountant must utilize, must understand, in how they are also going to use the standard. In other words, it is like the manual for the standard. It is not a standard, but a manual for the standard. It is just like when you buy your TV or your phone, they come with what we call manuals. You understand me now? So the manual as to how you should use your phone or use your TV, that's what conceptual framework is all about. It was issued and revised in the year 2018, and then they give an overview of as to what exactly the standard should look like, and what exactly when accountant, professional accountants or professionals are preparing and presenting a financial statement, this is what should guide them. It has 8 chapters. It has 8 chapters. Please note that you can be asked in your exam to write out the 8 chapters, and that's why you must know it. Very, very simple. It has 8 chapters. The first chapter talks about the objective of general purpose financial report. Objective of general purpose financial report. And it's very, very simple. What is the general purpose? Why are you even reporting? That's the simple meaning. Why are you reporting? And the answer is to help the users to make an informed decision. To help the users to make an informed decision. Quality economic decision. And so if the information you are providing cannot help the users, it means the information is as useless as the word useless. So that is the core objective. So the primary objective of general purpose financial report is to provide financial information about reported entity that is useful in making a quality decision. For instance, you want to buy or sell or hold an equity or debt instrument in an entity, the information you are providing will guide us. That is that for that. So the information helps users to make an economic decision. Now, you can be asked in your exams that who are the users of this financial statement? Users of financial statement. We have quite a number of users of this financial reports or financial statements. We have the shareholders themselves. They use this. And what do they use it to do? They can use it to assess the performance of the entity over a period of time. They can as well use it to compare the years of performances. That is the prior years of performance. They can use it like that. So we have the shareholders. We have the government. The government, they can use it to know the level of compliance to the regulations of the land. We have also number 3, the lenders. The lenders, they can use financial information that you provided to ascertain the credit worthiness of an entity. That's that for that. Number 4, you have the creditors. That is those that are selling to you on credits. People you are buying from. They want to know whether you can be able to pay back their money in the nearest future. And then we have other stakeholders like employees, members of the public, and a host of them. They need to know the holding nature and status of the entity. Why do I need to go back to this? I have seen it over the years that they can ask you questions that who are the users of financial statement and state their needs. Why do they need the information, or why do they need those reports that have been presented? I've just mentioned them. Creditors need to know if you are creditworthy. Government need to know if you are regulatory compliance. Shareholder needs to know your performance. Lenders need to know if you are creditworthy. The stakeholders, the employees, for instance. Are we okay? Are you seeing me, please?
Yes, sir.
Yes, sir.
Yes, sir.
Thank you. So, chapter 2 talks about the qualitative characteristics of this financial report. Very, very important. When they say qualitative characteristics, it means that what is the quality of the information you are even giving to the members of the public? What is the quality? That's what they mean by qualitative characteristics. And so for an information to be of quality, they must have the following characteristics. It can be divided into 2. We have the fundamental qualitative enhancing. The fundamental means that the core, very, very important. Germane. Let me use English now. Germane, very, very important. That's what we call the fundamental. So this qualitative characteristics has 2 legs. The first leg is the fundamental. The second one is the enhancing characteristics. And then the fundamental characteristics are the fire number 1. For you to say the financial report relevant, it means that it has what we call a predictive value. That is, it can help the user to predict future outcome easily. Take, for instance, a company that make profit year 1, year 2, year 3. As an investor, it will help me to predict that in year 4, this company will make profit. Is that not so? That is so. Year 1, year 2, year 3, you are making profit. It simply means that no matter what it is, year 4, you are going to make profit. So it helps you to make a predictive outcome, future outcome. It also helps the users to confirm and revise the past evaluation. That is, you can refer back to the past histories of the entity. So information is relevant. Number 1, if it is material enough. That is, if it has the capacity to be useful to predict the future or to evaluate the past. Let me take that again. Information is relevant if it can be used by user to predict the future and as well, evaluate the past. So if the information cannot be used to evaluate the past, you cannot use it to also predict the future, it is not relevant. And so take note of that. Fundamental qualitative characteristics, they are just two. It must be relevant, and then it must be the information must be faithfully represented. The second of the fundamental characteristic is that it must be faithfully represented. Faithful representation. In other words, financial information must be neutral, must be complete, must be void of any material error. You must present the information on financial statement faithfully. In other words, there are no bias, there are no window dressing, there are no cutting corners. It is just the way it is. That is how you are presenting it. It must be complete. So in you now, for instance, explaining it when they ask you in your exam, in you explaining it, you must understand that when they say fundamental related characteristics, you should state it. You have two. I call it R and F. That is F and R, faithful representation and relevance. Relevance means that the information must be able to influence the decision. In other words, the decision maker must be able to predict the future with the information, as well as revise the past. That is, evaluate the past, confirm what happens in the past. And number two, faithful representation. It means that the information you are presenting must be complete, must be neutral, must be free from any form of material error. That's that for that. And then we now have what we call the enhancing characteristics. That is, if these ones are the fundamental, very important, very germane, very, very, okay for us, for you to say this information is vital. Well, there are some of those characteristics that are also enhancing. Number one is verifiability. I call it verifiability. That is, information you are putting on the financial statement must be verifiable. It must not be from the blues. It must be verifiable. That's number one. Number two, understandability. It must be understandable. The user must be able to understand it. It must not be too ambiguous. I mean, very, 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 very complex. It must be understandable. Number three, it must be reliable. I mean, I must be able to rely on the information that you are giving on to me. And then number four, it must be timely. It must be timely. So that is that for that. So comparability, verifiability, timeliness, and then understandability. So these qualitative characteristics, as it were, I used to have an acronym that I also give to it, and I call it what I call FADA or FRV court. FRV court or FADA. Sorry, please, let me not use that word. FRV court. I think it's better that way. FRV court. F stands for faithful representation. R stands for relevance. V stands for verifiability. That is, I can verify it. C stands for comparability. I can compare the information over different years and across different entities. Understandability. I can understand it. Timeliness. In other words, information must be timely. When we say timeliness, it means that the information you are presenting must be useful in the current. In other words, you cannot use 5 years information and put it in this year's financial statement. It will be outdated because inflation rate is changing, the lending rate is changing, interest rates are changing. So all of these cannot make the information that you are presenting, the information of 5 years will be relevant as at today. That's what we mean by the timeliness. So please note this, is very, very important. I'm begging you to note it now. FADA V court, that is the acronym. Keep it in your left hand. Thank you. So can we go ahead? Any question? Is everything going on well? Are we clear enough? I hope I'm not talking too much.
No, sir.
All right.
No, sir. Everything is
Okay,
good.
so let's go ahead. So now, what is the third chapter? The third chapter talks about the financial statement and then the reporting entity. Financial statement and the reporting entity. Financial statement talks about what exactly are the content of the financial statement. So a reporting entity is an entity that is required or an entity that choose to prepare financial statements. It can be a legal entity or a division or a branch of the entity. So we have two types of reporting entity. We have the single and then the group. The single means a standalone entity, that does not have subsidiary, does not have associate or a joint venture arrangements. So it's a single entity as it were. And then we have group. The one that have subsidiary into associate or as a joint venture. So that is types of that. That is that for that. And then everything you just need to know in this financial statement, the reporting entity is what I've just told you. Don't bother yourself much. Just as chapter 3 talks about financial statements and then the reporting entity. And then you have the elements of financial statements. Sorry, please, before I go ahead, the financial statements. Financial statement talks about the components of a financial statement. I just omitted that. And I've seen that I've omitted that in this material. I will update it. Component of financial statements. We have 5 key components of a financial statement. That is the summary of all of the financial statements are in 5 headlines. We have the statement of financial position, SOFP, component of financial position. That's what I'm mentioning now. We have the statement of financial position, statement of profit or loss, and other comprehensive income. We have the statement of cash flow, statement of changes in equity, and then what I call statement of changes in policy, which is also known as the notes to the account. Please take note of what I've just said. So I went for an interview some years back or so, and then they were asking me that what are the components of financial statements. I just laughed because a lot of persons may not know. Component of financial statement differs from the elements of financial statements. So component of financial statement are what I've just mentioned. You have the statement of financial position, statement of profit or loss, statement of changes in equity, statement of cash flow, as well as statement of policy, which is also known as statement notes to account. Please take note of that. Then we also have the next chapter, which is chapter 4, that talks about the element of financial statement. The elements of financial statement. The elements of financial statements are the headlines in the components of financial statements. Elements of financial statement, they are the headlines in the component of financial statements. So we have the elements will be the following: the assets, the liabilities, the equity, income, and the expense. Please take note. Don't get yourself confused. Component is different from elements. Components is different from elements. Ibrahim Adioti, you have a question? Go ahead. You are raising your hand, Ibrahim Adioti. What's the issue? Okay, so let's go ahead.
I have a question, sir. Sir.
Right.
Hello, sir. Please, I want to ask a question about that, the component of financial statement. This on the statement of profit and statement of profit or loss and other comprehensive income. I just wanted to let us know the difference between the statement of profit or loss and the other comprehensive income. Are they the same thing, or if there's any difference, please let us know, sir. Difference between the statement of profit or loss and the statement of other income. Thank you, sir.
Okay. To start with, there is something like profit and loss. It's profit or loss and other comprehensive income. There are two different statements. Profit or loss account is a statement. Comprehensive income is also a statement, but they are two in one statement. That's why they say profit or loss and other comprehensive income. Other comprehensive income, they are the non, let me say the non-monetary income that you make within the year. Example is your revaluation gain. You understand? That's why you see it on other comprehensive income. Other comprehensive income. You understand? So you have your profit or loss where you look at your income and your expenses, and then you have your profit or loss for the year. And then you have another baseline known as other comprehensive income. There, that's what you put. If you have other non-monetary income, that is those ones that came from not that the income that comes in not from your core activity for the year. Like I mentioned, the revaluation gain. You did a revaluation of your asset and there is a gain. You report it as other comprehensive income. Where you also have all this foreign exchange gain, foreign exchange transactions, and there is a gain. You also report the gain under that other comprehensive income. So there are two different statements. So you have a two-in-one statement. That is why it's called profit or loss account or income statement and other comprehensive income, as it were. So profit or loss account and other comprehensive income. Is that clear enough? Adioti? Thank you. So let's go to the next chapter. That's okay. So we are talking about chapter 4 that talks about the element of financial statements, asset, liability, equity, income, and expenses. And then chapter 5 talks about recognition and the recognition. That is, items that you are recognizing on the financial statements. What are the criteria that must be met? You cannot just recognize any item on the financial statement if they have not met with the criteria that are required. And there are two key criteria. Number one is that every item that you are recognizing on your financial statement must have what we call the probability of getting the entity future economic benefits. It is either there will be a future economic benefit flowing or from the entity. In other words, it must tell us whether the items that you are recognizing is bringing in benefit to the entity or taking out benefit from the entity. Now, let's go back to the elements of a financial statement. For instance, assets. An asset, as it were, is bringing in future economic benefit to the entity, whereas liability is taking economic benefit from the entity. Income is bringing in future economic benefit to the entity. While expenses is taken out from the economic benefit of the entity. So for any item that you are going to recognize, the probability must be high, that is above 50%. It must be probable that future economic benefit will flow in or out of the entity. That is number one. So probable. Please keep this word because we will use it very well subsequently. It must be probable. Number two, the cost must be reliably measured. You must be able to measure the cost. In other words, any item that you are putting on the financial statement must carry a monetary value. There must be a value attached to it. And that's why you don't put narratives on the financial statement. We use a figure, and those figures, they have an amount by the side of it. So the first one is it must be probable. If you cannot remember the one that is, we want to remember, it must be probable. If that's the only thing you remember in the exam, or the examiner will feel okay, you remember, but you cannot, there is no time for you to explain. And then the second one, the cost must be reliably measured. That is measurement of the cost. That is that for that. Then the recognition simply means when you have to remove those items from the financial statement. And the criteria is also simple. Once an item on the financial statement is no longer meeting the recognition criteria, recognize it, that is, remove it from the financial statement. It's as simple as that. Very clear? Is it clear enough? Can we go ahead?
Yes, sir.
Thank you so much. So that is that for that under chapter 5. We have recognition and the recognition. Chapter 6 talks about measurement. Measurement. In other words, remember I told us in the recognition and the recognition, one of the criteria is that you must be able to, attach cost. Measure the cost that you will add to the items that you are putting in the financial statement. So that measurement is what we are looking at in this chapter 6. In other words, you must be able to determine the amount, the monetary amount that you are going to attach to those items in the financial statement. Very, very important. the cost must be measured. You must be able to measure it. So measurement is what determines the monetary amount. And the financial statement are to be recognized and reported as it were. So very, very simple. Measurement means how to calculate, what to calculate, you know, in terms of the items that you are putting on the financial statement. So we have major 4 measurement bases. Please take note of this also. You can be asked in your exam. The measurement basis in financial reporting. Number 1, we have what we call the historical cost. That is, an item in the financial statement can be measured at its historical cost. That is, the amount you pay or you receive to, buy or sell an asset. An asset or liability, to offset a liability, or income or expense, as it were. So the amount that you have to pay, for instance, when you incur an expense, or the amount that you receive when you get an income. You understand? That initial cost that you can identify. Take, for instance, now, if you sell, if you are into selling of goods and services, let's assume you are into sale of computer. You understand me now? If you are to recognize your income, that amount that you sell, your computer is what we refer to as the historical cost or the historical income base, or that you will use to recognize the income. Please take note. So when you say historical cost, that is the initial cost, and usually this is what we refer to as the initial recognition of any cost that is to be attached to any items on the financial statement, be it asset, be it liability, be it income, be it expense. That initial recognition is that amount at the beginning, the first time in and out of income or of money, as it were. Please take note of that. Then you have the next one, which is the current cost. That is the amount that we pay to acquire an asset or settle to transfer a liability. The amount that will be paid. If you are to pay for an asset or pay to settle a liability. And this current cost can be divided into 2. We have the fair value and the realizable value. So what have this current cost, as it were, has what we call the fair value and then the realizable value. So the fair value means what exactly will you earn? What will you gain if you are to sell an asset? Or what amount will you be willing to pay if you are to settle a liability? That's why we call it the current cost. You are not selling the asset. We are going to look at FRS 13 fair value measurement in our subsequent class, and you understand better. So if I am to sell this asset, now I'm not selling it today, but it's not that I want to sell it, but if I'm to sell the asset, at what amount will I be willing to sell the asset? That is what we call the current cost. And if I am to settle the liability, at what amount will I be able to settle the liability? And then you also have the realizable value. It's also a type of current cost. It's a type of current cost. So current cost can either be fair value or a realizable value. Please take note of that. Realizable value means if I'm to sell the asset or sell the liability, how much exactly will I obtain? And usually, realizable value, when you have to determine your realizable value, you have to do some level of adjustment. When we also get to that fair value, or when we're looking at IS 36 and IS 40, you understand it better. But note that we have that for that. Then we have what we call the present value. That is the future value being discounted into today's value. The future cash flows, what you are asserting in the future as cash flows, you are discarding into today's present value. This one takes note of what we call the time value of money. You know, the value of money today cannot be the value of money tomorrow. It is impossible because there will be inflation, there will be all manner. So what exactly what is the cash flow in the next future? You look at it and then you discount it into today's value. So these are the common measurement bases in accounting. Please note it and put it on your left hand. Historical cost, current cost, realizable value, and then the present value. Please take note of that. And so we move down to the next chapter, and that talks about chapter 7, presentation and then disclosure. Presentation means how you are going to present. Disclosure means what are the things that you are to disclose. So financial statement must present information clearly and disclose necessary explanation. Very, very important. So how are you to present? In your statement of financial position, asset comes first, and then equity and liability follows. That is method of presentation in your statement of financial position. In your statement of profit or loss and other comprehensive income, your income comes first, expense follows, and then other comprehensive income follows. In your equity and liability, the shareholders' equity comes first, and then other reserves follow. In your liability, your non-current liability comes first, and then your current liabilities follow. So that is a method of presentation. For disclosure, it is important for you as a preparer to disclose every details that need to be disclosed to members of the public. And that's why we have what we call the notes to the account, which is also known as the statement of policy that you have adopted, everything that you have done. So you must tell us if there is any aggregation, that is, any similar item that you aggregated, you must state it. The similar item all the similar items, you are to separate them. How you classify entities should also be disclosed. Offsetting, it is not allowed. It is not allowed in accounting. Understand also that offsetting, asset must be for liability, income must be for expenses. You are not to offset unless it is required or permitted by IFRS. You cannot use asset to offset it against liability. You cannot use income to offset it against expenses. However, you must recognize assets and liability within the same period and recognize income and expenses within the same period. Please take note of that. So your disclosure must present and provide relevant details that you must use, that you have used rather, in preparing and presenting your financial reports. So that is that for that. Then you have the concept chapter 8, concept of capital and capital maintenance. When we talk of capital, we are talking about the money that you use to start the business. Let me just use it in that literary form. The money that you use to start your business is known as the capital. So when we say capital, it simply means the contributions into the business, as it were, the money that is being used to start the business. So when we say capital and capital maintenance, there are two different things. Capital means the amount that you have invested in the business, so to say, literally, let me put it that way, so that you will understand it. While capital maintenance means the threshold of that capital that you have invested in the business that you must maintain in the business. As you are doing the business, you must maintain that threshold. It must not be less, as it were. What this simply means is that, take for instance, I invested 20,000 naira into this business in the year 2024. At the beginning of the year 2025, that capital that I introduced into the business must be maintained. That's what we call capital maintenance. That amount that I introduced into the business in the year 2024 must be maintained at the beginning of the year. And at the end of the year, I have to compare it to be sure that that capital is still in shape. That is just the literary meaning of capital and capital maintenance. So it is a concept that concerns itself as to how changes in capital over the accounting period is to be recognized before you can say you have made profits. It's as simple as that. Please just note what I have just said. Capital is the money that you put into the business. capital maintenance simply means that the money that I put into the business must be maintained at the beginning and at the end of the financial year. You understand? So it's as simple as that. So it has two concepts. We have two concepts of capital and capital maintenance. The first one is a financial capital maintenance. In other words, capital maintenance, you can use two approaches to actually maintain your capital. We have the financial capital maintenance and the physical capital maintenance. Summarily, the financial talks about money, that is using the monetary value to determine the capital maintenance, whereas the physical is talking about using assets. And here you have to consider inflations. So financial talks, as its name sounds, financial talks about money, physical talks about assets. We are still going to dig deep to it. So let's go. Financial capital maintenance. Of course, when an entity financial capital is maintained over a period, I've said that before. So you can only say you have made profits if the financial amount of net assets at the end of the period exceed the financial amount at the beginning. In other words, you can only say you have made profit in the year if your capital base at the end of the year is higher than your capital base at the beginning of the year. Remember, I was using an example of 10,000 naira. I started the business 10,000 naira in 2024. In 2025, it is so that my 20,000 naira will still be in flow. Now, for me to say I've made profit during the year, I must compare my 10,000 naira at the beginning and at the end of the year. If there is an increase in my capital base, you know that when we talk about capital, we are talking about the equity structure now. That if you go to your financial statement, financial position, we have under equity, we have the share capital there, and then you have the share premium. You understand me now? So you cannot tell me that because it is very that your equity remains the same, except if there are additions within the year. So your share capital in the last 5 years can be the same thing for 5 years, for 10 years, for 20 years. It may not change. But it is expected that you must compare that share capital. So at the beginning of the year and at the end of the year, if your share capital decreases, you can never say you have made profit. That is what this capital maintenance, financial capital maintenance is talking about. So how do you express it? You express it in nominal monetary units. You understand? And this is what IFRS actually accept the most. Huh? Very, very simple. It's not something that is difficult to handle. Just have the understanding of it. You know, you can only say you have made profit during the year when you compare your capital at the beginning and at the end. If your capital at the beginning is different from your capital at the end, there is something is wrong. But if your capital at the beginning and capital at the end is the same thing, then you can say you have made profit. Please take note of that. Let's look at this example. This company opening equity capital at the beginning of the year is 10 million. And then the closing equity at the end of the year is 12 million. But then the dividend that was paid out during the year is 1 million. How do you calculate the profit for the year? Remember, I said you will compare the opening with the closing before you say you have made profit. So now, the closing equity is 12 million. When you minus it from the opening equity, you have you're supposed to have 2 million as profit for the year. But because the entity paid out dividend during the year, you cannot say you have a profit of 2 million. Rather, you are going to declare that you have 1 million as profit because you have paid out dividend of 1 million. 1 million. So the capital base of that company is actually going to be 11 million at the end of the financial year. See, this thing is actually very simple. It's just some grammatical, stuff that I see with, with ICANN, not ICANN, International Accounting Board, as it were, under this conceptual framework. Now, look at it this way. When you make profit for the year, there's what we call dividend paid out, and there's what we call profit that is reserved profit. So what this thing is telling us is this. If you pay dividend out during the year, you cannot say you have made profit for the year because the dividend that you pay during the year is not part of the you can't say it's part of the profit that will, enhance the business, that will increase the value of the business. Because if you pay dividend out of the shareholder, you don't know what they will do to it. They are not investing it back into the business. But the one that you reserve, the one that did not distribute, for instance, will be reversed back into the business, and it will enhance the capital structure of the business. And that is why if you go to the equity portion of your statement of profit or loss, your statement of financial position, under the equity structure, you have share capital, and then you now have retained earnings as part of the equity structure. You understand now? So the more the retained earning, the more you are increasing the share capital base of the entity. You understand now? So capital maintenance is also is just talking about the fact that you cannot decrease beyond the capital that you invest during the business. If you decrease, it means that something is wrong. So it is expected that as financial professional, you must ensure that the capital base of an entity remains the same or increases over the year before you can say a company have made any profits. You understand? And there are two concepts that you are going to use. The concept of money, that is financial now, that is you look at the profit that has been made during the year and look at the dividend that have been made during the year. Now look at the capital base for the year. What did they start with? And how do you identify what they start with? It is by looking at the previous year, what they close with the previous year. You know that your previous year closing will be your opening for this current year. You understand me now? So once you have that opening, check what you are closing with during the year. First of all, check what the dividend, if they pay dividend out in the year. If they did not pay dividend out during the year, then it means that your opening plus your minus your closing will give you the actual profit that was actually made for the year. But you must always maintain your capital structure. That is what this one particular concept is talking about. Then the second one I said is physical capital maintenance, and this one talks about asset. Like I said the other one you use money, this one you use asset. This one is looking at your production capacity. Production capacity, what produces resources in an entity or what produces goods in an entity are the assets. And that's why we say these are what you use to produce future economic benefit. So it is your asset. So you must compare the productive capacity of your entity at the beginning and at the end before you can say you have made profit. What is the value of your asset at the beginning? What is your value of your asset at the end before you can say you have made profit? And remember, your net asset is always equal to your equity minus your liability. Let me not bring that in so that I won't confuse us. So that is that for that. So let's look at this example. So at the beginning of a year, manufacturing company has a machine that produces 10,000, 100,000 units annually. Due to depreciation by the year end, the productive capacity has reduced to 90,000 units. The company sells products but reports no profit because the physical capital has decreased, indicating that profit is not maintained. So what I'm saying here is this: at the beginning of the year, the asset of the company can produce 100 units, but at the end of the year, due to depreciation and usage, the capacity have reduced to 90 units. And so therefore, we cannot say that the company have generated any profit. Why? Because the productive capacity of the entity is not maintained. It has reduced. Please take note of what I just said. So we are comparing the opening and the closing. So you can as well report that the entity did not maintain their capital structure. It's as simple as that. So please take note of what I've just said. You can be also, explain all of these capital and capital maintenance. You can be able to do it. Please, it's as simple as this. So quickly, I want us to do this question, class. This question is for you, and I want you to do it for me. Okay, victory accounts. Go ahead, ask a question.
Hello, good afternoon.
Good afternoon.
Please, can you take number 4 again, chapter 4?
Chapter 4, that's financial statements, right?
Yes, I didn't get it.
Chapter 4 talks about I think elements of financial statement. Yes. Elements of financial statement: asset, liability, equity, income, and expenses.
Oh, okay. Thank you, sir.
Are you
I
okay?
didn't get it before.
All right.
Yes, sir.
All right. Okay. All right. Okay. Well, let's just move ahead. I will have loved that you do this question, but I think I want us to cover more than what we have covered right now. Okay, let's look at this. The answer is already here. A company net asset is 5 million, closing net asset is 6.5. During the year, Ayeni, you have done it. Thank you so much. Okay. Thank you. All right, so you have done everyone. Okay, can we all do it together now? Let's all do it together. Even though I put yeah. Give me your answer. What is your answer? Ella or Rejoice, you are raising your hand. Go ahead.
Hey, good afternoon, sir. I didn't get the explanation for this fiscal capital maintenance, please.
Well, I said the physical capital maintenance talks about the fact that you compare asset at the beginning to asset at the end. Usually, the productive capacity of an entity. You understand now? So, if the productive capacity of an entity at the beginning is lower to what they are closing with, it means that they cannot say they have maintained their capital base. And it also implies that they cannot recognize profit for that year. So whatever profit that they have made for that year must be used to make up the capital capacity of that entity at that period. You understand now? So you are comparing assets usually under physical and capital management. That is why IFRS actually believes that it is better we use the financial rather than the physical, because now look at it this way. The way and manner by which you depreciate, by which entity depreciate their items differs. Some can use 5% for motor vehicle, and another can use 20% for motor vehicle. That is why it is not uniform, as it were, and that is why IFRS also say it's better we use the monetary, which is the financial capital maintenance approach. So why I'm just bringing it up is so that you have an understanding of the two. The financials talk about you cannot identify profit for the year without you being able to, check what your capital base were at the beginning and at the end. And if there is any dividend, you have to also recognize it. In other words, you cannot just declare profit for the year or profit that will be retained during the year to be out of the capital base without you comparing the beginning and the end. That is the opening and the closing of your capital base. Whereas the fiscal is talking about you comparing the asset at the beginning and the asset at the end.
Okay, thank you, sir.
All right. So everybody's giving all kind of answers. Some say 2 million, some say 1.5, some say. Let's look at what the correct answer is. Remember the question. A company had an opening net asset of 5 million and a closing net asset of 6.5 million during the year. The company issued new share of 500. Calculate the profit for the year based on financial capital maintenance. Remember, opening is 5, your closing is 6.5. And then the company issue new shares of 500. Calculate the profit base for the year. Now let's check. Please, for when you are treating any financial capital maintenance question, this is the formula you must always follow. When they say determine profit, your profit must be always equal to the closing minus opening minus new share. And if there is any dividend, you put minus dividend that is paid during the year. Minus a dividend. Please take note. Minus a dividend paid. Not dividend declared. Dividend paid during the year.
Yeah, please, I'm using my hands.
Okay.
Sir, can you hear me?
Please go ahead. I can hear you.
Okay. Sir, please, sorry for taking you back. Please, I didn't quite get that chapter 3, that financial reporting entity. you said something about group and single components, so you didn't kind of expatiate it. Can you please help us, sir?
Okay. Okay. Let me just go back there. When we say single, single means an entity that does not have subsidiary, it's not into any joint venture arrangement, and it does not have any associates. It's a standalone entity. A very good example is which company is that now in Nigeria? For instance, we have MTN Nigeria. MTN is an entity that does not have subsidiary, does not have it's just MTN. Right? So you can have Afolabi Fumi Nigeria Limited. Afolabi Fumi does not have any associate, does not have any subsidiary as it were. So it's a single or a sole entity. Whereas group now, that means you have other subsidiary in you. So we have, for instance, Dangote group of company. Dangote group of company is a group entity. So that's what we call reporting entity. So reporting entity can either be single or group as it were. Either group or sole or single. Is that taken? And I said we are component of a financial statement also in that chapter 3. And I told you we have 5 of them. You can quickly mention it. The 5 components of a financial statement. Lauren, go ahead.
So can I mention it?
Somebody is raising their hands. Afolabi, wait. Lauren, go ahead.
Statement of financial position, statement of profits or loss and other comprehensive income, statement of changes in equity, statement of cash flow, and statement of changes in policy or notes to the account.
Thank you so much. Please help me clap for Lauren. I'm giving you 2 marks. Please be claiming it. That's how people in the last class they claim and they are passed. Be claiming the mark as I'm giving you, be taking.
I take it.
All right, thank you so much. So can we go ahead now? Look at the question we are looking at here under the financial capital maintenance. So the opening is the closing is 6.5 million. Well, you minus it from your opening, and then the share issue during the year, you are going to have the profit for the year to be 1 million. So for those that got 1 million, your answer is correct. For those that did not get it, your answer is still correct. It's just from the way that you did it. Because we don't have the explanation before now. But for your attempting, you also have a mark. Is that clear enough? All right, thank you so much. So let's take let's go to the
I want to ask.
Go ahead, please.
I'm looking at it. This formula now. The 500,000 that is issued, new issue of shares. Is it not that money came into the company? Is it not that? So why did we have to remove it? We issued new share. People subscribe.
Is that
so? Money came in, so that increased. So that compared to the dividend compared to the dividend that we paid from our profit.
That went out.
Yes.
Thank you. Now let me ask you this question. If you are issuing share, if we are going to issue share, the share that will be issued, will it be used in the current financial year or in the subsequent financial year? And Laura, I'm asking you.
It depends on the period you are issuing the share.
No, don't say period. Don't look at period. That's why I say that be careful with, that's why you have to check your beginning and your closing.
Yeah.
You understand me now? If you issue share during the year, there is no way you can optimally, because you see, for you to inject funds into a business, you understand me? It means that you are going to use it for a whole complete financial year. Is that also? So if you are raising a new issue during the year, you should know that there is no way you can have a complement of it fully within the year, and that's why we are removing it, because it cannot form part of what you have used to trade during the year. It will only be applicable in the subsequent year. Is that clear
Yes,
enough?
it's clear.
Thank you. So please, I love this kind of question. It makes you to think logically as an accountant. And remember, one of the key traits or one of the key qualities of an accountant is your skepticism, being logical, thinking beyond the box. Ask, why is this so? Why is this not so? Don't think that everything I'm telling you is the correct thing. Ask me, why is it correct? Let me tell you why it is correct or why it is not correct. Is that okay? So let's go ahead. Let's look at this question. I'm sure you can attempt this question. Just snap it, give me the solution. Snap it and give me the solution. A company operating productive capacity is 10,000 at the year end. Due to inflation, the replacement cost of the machinery increased by 10%, but the physical capacity remains 10,000 units. So the company recognizes profit based on physical capital maintenance. I want you to go and think about this question and give me the answer. What is known now, Afolabi? For me, what is the issue?
No, I was trying to attend to the question. So based on this question now, they said the company opening product capacity is 10,000 units, and at the end of it, due to inflation, the replacement cost increased, and the capacity level still remains 10,000 units. So in this case, I'm not sure the company will be able to generate profit. Instead,
so respond to me on the group. Respond to me on the group. Don't answer now. All right.
No, sir.
Please go ahead.
No, sir. Please, can I ask a question?
Go ahead, please.
I want to go back to the last question. Yes, can you hear me? Can you hear me?
Yes, I can hear you.
The last question that you said, can you hear me, sir?
Yes, please.
That one that somebody asked a question concerning shares being issued of 500K. You know,
Yes.
Please, can you go back to the question? Let me see. I want to ask something. There's something I didn't really understand. I don't fully understand in that question and the answer therein. So you know, okay, the net opening asset is 500 6.5. So and they issued a new share of 500.
They did not pay dividend. So it will be minus 0. Since they did not pay dividend, that will be minus 0. And
So
then the profit
when
will
you
be
minus 6.5 minus 5 million, it should be not the profit should be. They did not pay dividend. So
6.5 minus 5 million will give you 1.5.
So they didn't pay dividend. So the profit should be 1.5 now. So since we didn't recognize the new shares, which other should be 2 million. So
1.5 minus 500.
6.5
minus 5 million, 1.5. 1.5 minus 500, 1 million.
5 million now. 6 million. It's 1 million 5 now.
Minus 500 now. Issued new shares.
No,
and that's why we are minusing it now.
To be the following year. So
we are minusing it in the current. We are minusing it in the current year because it will not be. It cannot form part of what is being used. It cannot form part of the because now as it stands, this 500,000 is showing as part of what they profit during the year. Yes, it's part of the 6.5.
That's what my question is. It's part of that 6.5. Okay.
Yes.
Okay. So okay. Thank you.
All right. Okay. Can we go ahead? Are we clear now? Can we go ahead, please?
Yes, sir.
All right. So let's go to the basis, accounting basis. There are other illustration in the material. You can get it, and then that is it. So let's look at this basis of accounting. There are 3 bases of accounting. We have the accrual basis, we have the cash basis, and then the modified cash basis, or hybrid as it were. So when we talk about basis of accounting, we're talking about the rules, the conventions under which financial transactions are to be recognized. You know, how you must recognize, measure, and report items in the financial statements. That's what we talk. That's the meaning of a basis of accounting. Basis, just as the name implies. Accrual basis, cash basis, and then the modified cash basis. Please take note. You can be asked in your exam. So, what is the accrual basis of accounting? Accrual basis of accounting is simply saying that for you to recognize any transactions and any event when they occur, for you to recognize any transaction or any event, it must be when they occur, not when cash or its equivalent is received or paid. That is the accrual basis. Accrual basis is telling us that for you to recognize any items, or for you to measure any items or any transaction or any events in the financial statements, it must be that you recognize it as when they occur and not when cash or its equivalent is being paid. In other words, take for instance that you sell goods worth 2 million naira now to, let's say, I'm the one now selling the good. I'm selling goods to Fumi for 20,000 naira. Now, I'm selling it today being the 17th of January 2026. Fumi pay me 10,000 naira. And he said that he will give me the other 10,000 naira in next week, by next week. According to the accrual basis, this transaction that will occur is known as sales. And so if I'm to recognize it in my book, it means that I will recognize the whole of the 20,000 because the transaction took place today. I must recognize the 20,000 naira in my book, whether or not Fumi give me completely the 20,000 naira today. Is it clear? Let me take it again. Let us assume that Olajumoke is selling perfume, and then he sold perfume to Victory. Victory bought perfume, bought 2 pieces, and each of the perfume is 1 million naira. And you know Victory is very, very, very rich, so she is buying 2 perfume for 2 million naira from Olajumoke. And then the transaction took place today, 17th of January. But Olajumoke said, look, I don't have the 2 million naira today until when I receive. Victory said, I don't have 2 million naira. Olajumoke, give me this perfume. I'll give you at month end when they pay me my salary. Because that event took place today, the transaction took place today, according to our accrual basis of recognition, we are to recognize that sales, that revenue, because it will cost today on our books as at 17th of January 2025, and not when Victory is going to pay the money, which is at the end of the month. Is it clear enough? I'm sure it is clear. So that is the accrual basis. So it is a measurement of accounting that recognize transactions and events when they occur, and not necessarily when cash or its equivalent is being received. Please take note of that. Then you have the cash basis. The cash basis is the other side of it. In other words, you recognize transaction when you have received cash or when you pay cash, and not when the transaction occur. That is the cash basis. Going back to our example, Fumi bought 20,000 naira worth of good from me. He gave me 10,000 naira, and he said at month end she will give me the other 10,000 naira. Using the cash basis, I will recognize 10,000 naira in my book. Then the other 10,000 naira I would defer it until when Fumi give me back my 10,000 naira and pay me back in cash. Do you understand it? So it's very, very simple. Revenue and expenses are recorded when cash exchanges hands and not when transaction actually occurred. Very, very simple. Whereas you have what we call the modified cash basis. Modified cash basis. It is also known as the hybrid cash basis. This one combines both the cash and the accrual basis. That's why it is called modified cash basis. It combines both the cash and the accrual basis together. So some transactions, for instance, are recorded on cash basis. Some are recorded on the accrual basis. So it depends on the nature of transaction. Let's go back to the example that we are looking at. The example of the 20,000 naira. Fumi gave me 10,000 and will pay me 10,000 naira at the end of the month. I can choose to recognize 10,000 naira in my book and then go to my receivable and put there 10,000 naira. You understand me now? So this one, combine it. You can decide to recognize the transaction as at when you receive cash and as at when the transaction occur. Is that taken? Now look at this example also. Inventory now. You can choose to recognize your inventory or that you purchase, that is the inventory that you purchase on cash basis and record depreciation as assessments on a monthly basis. This one may be confusing, but just maintain what I've explained to you as the examples. It's as simple as this. Please know these three bases that I've explained to you. It's been a long time that they ask question on this. Note it. Ibrahim Malam Shehu, go ahead. Ask your question. Okay. Since there is no question, let's look at this question. Look at it here. It says, a company, that's discuss the three bases of accounting. This I CAMA 21, question 3. You can see it. I only put it here so that you can see that they have been asking questions on this basis. This question is, I think 4 or 5, I can't remember. If you don't know it, you don't know it. But if you know it, it will help you. It will help you a lot. Imagine that you have 3 marks or 4 marks in your kitty. You are only looking for small mark 47 to qualify. That's why you have to be handy with certain of these topics that we are looking at. And so that is that for that. Then a lot of questions are also here in the material. You can check through to help us a lot. So let's look at the last one for today, and that is talking about substance over form. Substance over form is also an accounting principle that tells us how, as professionals, we should recognize transactions. How we should recognize transactions. As professional accountants, we are being guided by the fact that we should recognize every transaction on their substance basis and not on their legal form. Because once you adopt IFRSs, it is important for you to, stick to the principles. A good example is the lease contract, as it were. Now look at it this way. Lease is a contract between the lessor and the lessee. Meaning the lessor is giving the lessee the right to use a qualified asset for a period of time. Now, this asset, as it were, belongs to the lessor. But the lessor is the one giving it to the lessee to use for a period of time. Now, look at it this way. That the lessor give the lessee the right to use the asset, does it transfer ownership of the asset to the lessor? No. in legal form. Because let me take it in a very simple way. Look at it this way now. I have a building, a warehouse now. I'm not using it. I just keep it there. And then in another approach me and say, okay, please let me use this your warehouse for 5 years. And since you are not using it, I am the owner. But in another approach me that they want to use it. And another is the lessor. I mean, it's the lessee. I am the lessor. I am the owner. The owner is the lessor. The person that is to use it is the lessee. She approached me that I want to use it for 5 years. Now, legally speaking, I am still as a lessor. I am the owner of my warehouse. Is that not so? But according to IFRS standard in IAS 16 and IFRS 16, you cannot call an asset if you don't have control over it, and if you are not using it to generate future economic benefit. In other words, once you have control over the use of a particular item, of a particular asset, it means that that asset belongs to you, as it were. That is what is it called? The conceptual framework also tells us in our chapter 4, where we talk about the elements of a financial statement, definition of assets. So you cannot call it an asset until there is a control of use. So now, if, for instance, I have a contract already with an landlord that if you use my warehouse for 5 years, it means I don't have control of the use of that warehouse in the next 5 years, meaning control have been transferred to an landlord. And since control have been transferred to an landlord, according to IFRS, we look at the substance of the matter. I no longer use it to generate future economic benefit, and the landlord is the one that is using it to generate future economic benefit. And that is what we call substance over form. In other words, as professional, you must look at the substance of every items that you are going to present in the financial statement. Look at the substance over their legal form, and then recognize them in the financial statements. And the reason is this is because we are undertaking what we call the IASB gap. Is it clear enough? Somebody have been raising his hand since, and along with that, you have been raising your hand. Okay, you can put down your hand, and along with that, okay, Victor, go ahead.
So sorry to take you back, but please, can you explain this substance over form in a layman form so I can be able to get it better?
In a layman form, the simple meaning is that as a professional, recognize items in the financial statement in their substance form and not in their legal form. Substance simply means the value they are adding to the entity, the control nature, and the value that they are adding to the entity. And I just give an instance of a lease contract now, because that is majorly where issues are, contentions are. I give an example now of a lease contract. Myself and you now, we enter into a lease contract. You have a warehouse. You are not using the warehouse. I approach you. Okay, let me use your warehouse, for 2 years, and I will pay you 100,000 naira per month. We agreed. Remember, in the eyes of the law, you are still the owner of that warehouse. Is that not so? But for us, that is using the accounting standard to prepare our financial statement, we cannot say that that warehouse does not belong to you, because you are going to use a warehouse in the next 2 years to generate income into your business. And because you are using the warehouse to generate income into your business, it automatically becomes an asset to you. And that asset, we call it right of use asset, because you now have the right to use the asset, and you have the right to control the asset in the way you want. So that is what we call substance. So the meaning is that you look at the substance of all of the transaction over their legal form, and you report it in their substance form. You report it in their substance form over the legal form. I hope I've been able to communicate now. Is it clear enough, or I should take it again?
No, it is clear. Can move forward, sir.
Okay. So the essence of this substance over form is that whatever you are putting in the financial statement must be true, and they must represent fairness, not just the legal documentation or formal titles. It must be clear enough. And I give example of the lease contracts. So the importance of this substance over form is whatever you are putting there, like I said, must be faithfully represented. And then it also prevents manipulation or distortion. And then it promotes transparency, reliability, and for comparability. So that is that for that. Any question? Okay, go ahead.
So please, my question is about that right of use asset. I said, sir, are we going to recognize rights of to use asset as a current asset or non-current asset in the
It's a non-current asset.
Okay.
Under your statement of financial position.
Okay.
Yes. So, please, that is that for that. All right. The modified cash basis. Somebody said I should recap again. Let me quickly recap the whole class. Then we'll go to past questions from 2021 to look at what has happened. Now, we look at regulatory and the conceptual framework, as well as the basis of accounting, source over form. I think there's another one which is in the material. When you get the material, you check it. The other core principles, the matching principle, prudence principle, materiality, they're also in that material. And so now look at it this way. We look at the regulatory framework, and then we give an overview. Without regulations, accountant will just be doing anything they like, and then it will affect a lot of things. And that's the overview. And then we look at the importance of regulations, and then we said that it is good to regulate because it will help uniformity of presentation and preparation. And number two, we said it will help to guide, to safeguard the confidence of users. You understand? And then we said it will be useful for comparability. If there are no regulations, you'll be able to compare financial reports that are being put in the public domain. That's the importance. And then we move from there to look at the sources of regulations and then the regulators. And I said we have four key sources of regulations, and we have the accounting standards, which the regulator is the Accounting Standard Board. We have the Corporate Matter Act, and the regulator is CAC, Corporate Affairs Commission of Nigeria, as well as the Federal Reporting Council of Nigeria. They are the one that ensures that the Corporate Matter Act are being complied with in Nigeria. It's also a source of information, and that CAMA is a legal source of information, while accounting standard is a principle-based source of information. So that's a very good example to also define our substance over form. So that is that for that. Then we have number three, professional bodies, source of income, professional source of regulation, professional bodies. And we talk about ICANN, we talk about ANAN, and then we went on down to ICANN, and we said ICANN is being enacted by the law of the Federation in 2004. They administer, they examine, and then they are the one that ensure that chartered accountants are well competent in whatever they are doing. And then they also provide what we call ethical guidelines. What should be the minimum guidelines for accountant? I told you that there's an acronym for that code, and it is called COPI. COPI means confidentiality, objectivity, integrity, professional due care, professional competence, as well as what is it called again? Integrity, or whatever I've mixed out. So just know it. And that is the guidelines that they give. And then the fourth source of income, source of regulation. Why am I saying source of income now? The fourth source of regulation is the industry where professional accountant works. And then the regulators can be CBN, and NINCOM, PENCOM, and all of such bodies. So those are the four sources of income. Sources of regulations. And I think that's where we actually stop looking at regulations framework. So please take note of that. Very, very important. And we came to a conceptual framework. And I told you that the conceptual framework is just like the manual that guides how the standards are to be applied. The manual that you and I are to be guided by in the way we carry out our duties. And I told you that it's a framework, a policy framework that has 8 chapters. Then the first chapter talks about the purpose of the general purpose financial reporting. Why are we doing reporting? And we said that it is so that it can give the users quality information and for quality decision making. That's that for that. And we talked about the users of these financial informations. And we said we have quite a number of them: the government, the stakeholder, the shareholders, and all of these put together. They also have their information need. Why do they need the information? You can be asking your exam. And chapter 2 talks about the qualitative characteristics. The qualitative characteristics of the financial statement, that is. For this financial report to be of help to the users, they must have qualitative characteristics. And I said we have 2 legs to it. We have the fundamental and then the enhancing characteristic. So the fundamental talks about relevance and then faithful representation. And then the enhancing talks about verifiability, understandability, comparability, and then the timeliness, which I call Father V Court or FRV Court as it were. That's chapter 2. Chapter 3 talks about financial statement and then the reporting entity. And the financial statements have 5 major components. We have the statement of profit or loss, statement of financial position, statement of cash flow, statement of changes in equity, statement of policy, which is also known as notes to accounts. Please take note of that. And then I told you that we have a reporting entity. Reporting entity is any entity that is mandatory to report, or those who choose to report their financial dealings within a financial calendar year. And so we said that this reporting entity can be single or group. Single means you are a standalone entity, you don't have any subsidiary and the likes. Group means you are not a standalone entity, you have subsidiaries, you have operating segments and the likes. So take note of that. That's chapter 3. Chapter 4 talks about the elements of financial statement, and that talks about the assets, the liabilities, the income, the expenses, and then the equity. That's the elements of financial statement. Chapter 5 talks about recognition and derecognitions. That is, you are recognizing or derecognizing an item on the financial statement. And what are the criteria for you to recognize? It must be probable to generate future economic benefit. That is number 1. And number 2 criteria is that the amount or the cost, as it were, can be reliably measured. That is, we can calculate it, as it were. And that's that for that. Then once an item can no longer fit in with this criteria, we have to derecognize that. We remove the financial statement. And then the next chapter talks about measurement. That's chapter 6 talks about measurement. That is how to calculate the value that you are going to attach with every item that is on the financial statement. And then chapter 7 talks about presentation and disclosure, how you have to present all those items. You don't do them shabbily, you do them very well. And then we talked about it as according to IAS 1 that talks about presentation. And now we have what we call IFRS 18, which will come into play from 1st of January 2027. And it talks about presentation and disclosure. It is important for you to disclose items and policies, how you arrive at various items that you have put in and the financial statements. And that's that for that. And then you have chapter 8 that talks about capital and capital maintenance. Capital talks about the amount you inject into the business. And capital maintenance talks about you being able to maintain a threshold of capital that you inject into the business at the beginning of every financial year. And so you cannot say you are going to declare profit or you have made profit from the year until you maintain your capital base. It's as simple as that. And then from there, we move to the basis of accounting. I told you that we have our 4 bases of accounting, if I'm not mistaken. Yes. Is that also? Let's go back. So it won't be as if I'm just talking and talking and talking and talking.
Basis.
4 bases.
3 bases.
3 bases, sorry. Before
Yes,
the
sir.
basis, we're talking about the measurement. Sorry, the measurement basis. Yes, the measurement basis, that's what we talk about.
Okay.
That measurement basis, we have 4 of them. We have the historical cost, we have the current cost, and then we have realizable value, as well as the present value as the measurement basis. Measurement basis means by which you can do your calculations, and attach value to the items you are putting in the financial report. And from there, we went to accounting basis, and I told you we have 3 accounting bases. We have the accrual basis, which says that items are to be recognized when transaction occur and not when cash is being received. That is accrual basis. And then the cash basis talks about the fact that you recognize transaction when cash is received and not when that transaction occur. And then the third one talks about a mix of the two, which is the hybrid or the modified cash basis. And it says that you can choose to use the two at the same time. That is, or you can choose to recognize an item when you receive cash or pay cash. As well, you can decide to recognize an item when the transaction occur and not when the cash is received. You can combine the two together. That's that for that. And then from there, we talk about the substance over form. As a professional accountant, you must look at the substance basicity of an item being guided by the principles of accounting standards in preparing and presenting items in the financial reports. And that is, I think, we actually concluded. And so quickly, somebody has already been thinking that I will not talk about. So let me just really talk about that. The core principle in financial reporting. We have the accrual principle. We have talked about that one. Please note it. Recognize transaction when they occur, not when cash is received or paid. Then we have the going concern principle. That is, it is expected that entity, for you to prepare an account for a financial year, means the entity will be in existence for a foreseeable future. Please take note of that. Consistency principle. That is to say, every policy that you are adopting and methods that you are applying in preparing and presenting your financial statement, you must be consistent with it. Don't change halfway. Take, for instance, if you are measuring your depreciation using the reducing balance basis at the beginning of the year, don't at the middle of the year now say you are changing to straight line basis. Every policy that you adopt, you must be consistent with it. They must know you with it. Don't change it over the time. Prudence. Prudence means that you should exercise caution in your judgment, in your estimate, in the way you recognize liability and expense. Exercise due care, quality judgment. You know that, for instance, some of the estimates that we are making, for instance, in depreciation, you must be very careful with it. It must be something that will not, jeopardize the decision of the user of financial position. Please take note of that. Materiality means that financial statement, every information you are putting on the financial statement must be material enough to make economic decision. In other words, they must be void of material errors. Void of material errors. And material errors occur when a misstatement or omission can cause a bad decision to be made. That's materiality for you. Reliability principle is also there. Relevance is also there. Matching is also there. We have talked about matching. Expense must be matched with revenue in the period which they occur to produce such revenue. You don't carry the revenue for this year to next year and match it against next year expense. That's that for that. So please, a lot of them are in this particular handouts, and then you do well to enjoy it when you get the handout. So thank you so much. I'm sure I've been able to deal with all of this. I will not let you go, because a lot of us may not know the essence of why we are doing this class. Grade A is regulatory and conceptual framework, but a lot of us will feel that there is no need for it. You understand? But there is need for it. It is 10% of your question. And I want to go to each of the past years now to show you questions, to tell you that they ask questions, 10 marks, 15 marks, 7 marks, 8 marks, that you can pocket. Why am I saying this? At the end of this class, sit down, look at everything that we have talked about, and put it at the back of your head. Let it be there, and make it look as if you are done with 10% of what you are supposed to know for this exam. Now, I want to go to the past years to show us some past questions. Some past years to show us some past questions. Please, let's quickly run through, and then we will conclude the class. Now, look at this particular question. Look at it. Question 7. I'm sure you are seeing it, right? Look at it. Conceptual framework say the qualitative characteristics of financial information required. Identify and explain 5 qualitative characteristics of general purpose financial statement. 10 marks. You can see 10 marks. So look at it. Oh. Qualitative characteristics. Who can quickly give me? So I will give you the 10 marks now. Raise your hand. You can give me the qualitative characteristics. What are the qualitative characteristics? Oh, yeah. Sharp. Let me talk about. Oh, yeah, go ahead. Let me talk about. Okay. Ibrahim, I don't want to call any other. He has had my mark today. Okay, Success Friday. Go ahead. Ibrahim, I can't hear you. So just wait. Let Success Friday speak.
Yeah, the relevancy, verifiability, understandability, comparability, and timeliness.
You see it now? So how do you answer this question? Very simple. Let me clap for my friend here. I'm giving you 2 marks for attempting, and you explain everything well. If you just go to exam and they tell you 5 qualitative characteristics, just remember FRV code, FRV code. Just remember. Now, how do you answer this question? They say identify and explain. Please, these are 2 key things. And I'm bringing this also that I will teach you something here. Identify and explain. In other words, you will first of all mention before you explain. You have 5 of them. Relevance. You put relevance. You underline it. You go to the next line. You explain it. That is how to earn your mark. The next one, faithful representation. You write it out. You underline it. You explain it. That is how to earn your mark. That is that for that. So let's go to another year. This is November 2021, question 7. You can write it down. May 2021, question. Let's check again. Question 6, I guess. I think so. Okay, see it here. Question 6. The qualitative characteristics of relevance, faithful representation, comparability, require. What is meant by relevance? Faithful representation, comparability, and now they make financial information useful. Did you see it here now? So they are asking you, this is 6 marks question. No? What is relevance? I've told you, relevance means that the details that is being imputed, the information that is being provided, is good enough for quality for qualitative, for quality and economic and decision making. In other words, you can use it to predict the future. You can as well use it to evaluate the past. What of faithful representation? Faithful representation means that what you have imputed in the information you have given to us is void of any form of bias, is complete, void of bias, is neutral, and good for economic and decision making. What's the comparability? Means that the information you have given to us, we can use it to compare your years of operations, or we can use it to compare the entities of like minds. You understand me now? You put this thing down now, you have 6 marks. So you put down relevance, you explain. Federal representation, you explain. Comparability, you explain. And then you tell us how they can be useful, which I've also explained. So all that we have looked at, you see that they are not a waste of time. 6 marks, you have it. You are looking for 44 to pass. So you see. So now let's look at. Oh, sorry, I didn't share the tab. Sorry. This is the question 6. This is the question 6, November 2020. I mean May 2021. Question 6. Explain what is relevance. You can see it there. So then the B part says 6 marks. The following round took place in Jahid Investments. The company entered into a lease rent. You can see the company statement of profit using historical cost method. Some was made by Jahid Investment Board of Directors to change the company's accounting policy from one officer expensing the finance costs on building and the likes. Explain how you will treat this item, you know, and indicate on which of the qualitative characteristics framework you treat your treatment is based. On which qualitative characteristics your treatment is based. Please look at this. Don't have more time. If I will have just, but let's just look at it together. They say a company enter into a lease to rent, and that's a pay 1 a year for 5 years out of its usual economy of 15 years. Assume a rate interest in place of lease payment. Now, this one simply means that you must faithfully represent this information. That is, you must only represent the substance of this very particular transaction over its legal form. In other words, you must determine the right of use of asset as well as the lease liability that is in this lease contract. So the qualitative characteristic is faithful representation. You must represent the information because substance over form actually has to do with you must tell us, you must represent the information faithfully on their substantial basis and not on their legal form. Number 2 is the company statement of profit or loss prepare using historical cost method. Show the loss from operating its hotel, but the company is aware that the increase in value of the properties during the year far outweigh the operating loss. Now, what is the qualitative characteristics here? In as well as they use historical cost method, it simply means that they are comply with the relevant qualitative characteristics. That is, the information that they have given here is relevant. It's far relevant. Now, look at it this way. They said they operate in loss, whereas the company value of properties during the year far outweigh the operating loss. That is far away does not mean that it is not a loss that they have made, as it were. I want to believe clearly that the company, they have prepared the information that is required for the member of the public to consume. In other words, they did not value the properties. They did not value their properties with the prevailing economic cost or value, as it were. And even if they have even value it will not increase or decrease the operating loss that they have made, because the value of the property, as it were, will only be reported in under the other comprehensive income. So it will not even affect the profit or loss for the year. So if they have used historical costs, as it were, to measure their profit or loss information, it means that they have prepared they have given us a relevant information as it were. Then the decision to made the investment board of directors to change the company's accounting policy from one of the expensing the finance costs on building new retail outlets to one capitalizing such costs. I don't understand this one, and I can't be cracking my brain. Please look at that question and revert back. So let's go to May 2022 diet and see the question they ask. This is May 2022 diet question 6. Look at it. They repeated the same question that we saw in November diet of 2021. Look at it. They repeated the same question. They discuss the qualitative characteristics which make information useful to users of financial statements. You can see it, right? Are we still together? We have all gone.
We are together, sir.
Yes, sir.
Okay. You can see it. Discuss the qualitative characteristics which made information useful to users of financial statements. You know them. Now, the B part, this is 10 marks question. Look at the B part. The National Republic of Nigeria is a federal policy under the supervision of the Federal Ministry of Trade and Investment. Require identify main objective of Federal Republic of Nigeria defined by the establishing the institution. 2 marks. My God. 4 main objectives. Remember what I said. I said they monitor, they can sanction. Is that also? They monitor, they can sanction. They tell us when to adopt. They when to adopt standards. They tell us when not to adopt standards. You understand? So they provide guidelines, as it were. Just mention it, and you have your 2 marks. The CPA said, please mute your mic, mute your mic, mute your mic, mute your mic. Who is that person? Hello. CPA said, required. Explain the term financial capital and physical capital maintenance. 3 marks. I've just told you. Financial capital maintenance, you know, that one deals with the monetary comparison of the capital at the beginning and at the end, whereas the physical capital maintenance deal with the production capacity or the asset of the company at the beginning and the end. They compare the capital base. So you cannot declare profit either of the 2 approaches. Whether you are using the 2 approaches, you cannot declare profit until the maintenance, the capital base of that entity is being maintained. Simple. You go. You can see, right? Now let's go to November 2022 and see what we have there. Question 4, November 2022. IFRS is published subject to appropriate level of ISB approval. This also includes describe 6 steps. Look at this. Describe 6 steps involved in the process of issuing international financial reporting standards. 6 marks. Explain 2 enhancing characteristics of financial information. 2 marks. How many is that? 8 marks. Imagine that they are giving you this question. 8 marks. Just go and do it sharp, sharp. Move. I told you about the steps. Don't forget it. Identify. Issue. Draft. I mean.
the issue.
What is it called? You identify the
Discussion paper.
discussion paper. Thank you. Oh yeah, go ahead. Be mentioning.
Prepare exposure draft.
Public consultation.
The issuance
Post
of
Review and
implementation
redaction.
review. Post implementation review.
Issuance of final standards.
Implementation and enforcement.
Yes.
You can see. You all know it now. That's how it will come for you. In this
Issuing the
exam.
standard.
I want to pray for you. This question will come at the way they give it like this to you in your exam.
Amen.
So now the answer is when the 2 enhancing characteristics. 2 enhancing characteristics. Who can really mention the 2 enhancing characteristics? Just mention that.
Relevance and faithful representation.
And verifiability.
This enhancing characteristics is different from fundamental.
Understandability.
That's the
Comparability.
Yeah.
Thank you so much. Reliability is the vehicle. Thank you. And that's that for that. So let's look at May 2022. Question 2. Identify and discuss the information needs of different users of financial statements. You remember I told you earlier that they can tell you to identify who are the users and what are their information needs. That's what they're asking. You see, 10 marks. Just identify 5 and mention their use. So who can tell me who are the users?
The government.
And what is the name of the
employee,
government?
The stakeholders.
Who are the stakeholders?
The owner of the business.
Stakeholders.
They are the owner of the business.
They are the ones who have interest in the business.
They are the ones
The owner of the business, the employees.
Like
Employees
employees,
who are interested in
the shareholders, the directors,
The investors.
the
Investors.
suppliers.
The lenders, the creditors.
My student on our head. Yes, I like this. So 10 marks. You have 10 marks. What do you need? Can you see my screen?
Yes, sir.
Okay, thank you. Then the B part says the common law matter act. So let me also state this now as we are proceeding. When you have a question, don't read the content. Go and read the required first before you come to the content. Because even if you read the required, you may not even need to read the content sometimes. So let's go to the required of this question. Say, briefly explain 5 issues which must be contained in a director's report in accordance to CAMA 2020. 5 issues that must be contained. The issues that must be contained, there are plenty. The first one is, what are the strategic decision of the company for the financial year? They must tell us. What are the profit that was made for the year, or the performance of the business for the year? The director must tell us. What are the dividend that was declared? The director must tell us. Who are the existing director in the current financial year? The directors must tell us. Are there any major hazards or losses that was made during the year? Are there any major issues during the year? These are things that financial directors report must always contain. So that's what they are asking you. They say, you tell us what the director's report must contain. The director, even if you don't know the section, you know they say director's report. And you know the directors, they are the one that they are like the overseeing of the entity. They are the overseer of the entity, as it were. You understand? They are the one that enforce corporate governance, as it were. So the report, once they say the report, you should know what it contains. Anything that comes to your head, just put it down. It's correct. The director's report must contain the profit that was made for the year, the dividend that was shared, the asset that is acquired, the directors, the present composition of the directors of the company, the shareholder exit or that was included, all of those such, and then you have 5 marks. Oh my God, then you are done. What else do you need? Question 3 they say default tax. Okay, this one does not concern you. So you can see that's May 2022 question 6 or so. Question 2, 15 marks. I pray they will ask this type of question and you will answer. So let's go to November 2023 and see what was also asked there. November 2023, question 7. Look at it. Within the context of this thing, discuss the main sources of regulation. Hey, you remember sources of regulation. Who can quickly mention it? Can we quickly mention it?
Professional bodies.
International Financial Reporting Standard.
International Financial Reporting Standard. Oh yeah.
Accounting standard bodies.
FRC.
Legislation.
Financial regulatory bodies.
Financial regulatory bodies. So the second one says, discuss 2 reasons why financial reporting practice should be regulated. Anybody that can try? Oh yeah.
For conformity.
Victory. Thank you, Victory. Thank you. I trust you. Yeah, go ahead.
Uniformity.
For uniformity, for comparability, for relevance, preventing creative accounting and window dressing. Thank you so much.
Investors.
To protect the investors. Oh my God! Thank you so pretty much. And that's our representation.
I'm gonna end down. Very for
as well. Can you hear me?
Yes, sir.
Yes, sir.
Sir, but we can't see your screen.
Don't worry. I'm going back now. Okay. You can see it now.
Yes, sir.
Yes, sir.
Okay. So this is where we are. They say give 5 examples of minimum line items to be shown on the face of statement of financial position. Oh, if I ask people to mention this now, you will not, and you know it too. We have looked at it too, but you may not know it. Who can try?
Elements of financial
Assets.
statement. Asset, liability,
Liability.
equity,
Income.
expense,
Asset,
and income.
liability, equity,
Income and
income, and
expenses.
expenses.
So thank you. I love that. So now what you will do again, since they say 5 marks, once you mention asset now, you will go further and say under asset, you mention we have PPE, investment property, intangible assets. You go to liability, you say we have provision. You know, just they say line items. So line items means what are those things that must be under the elements of the financial, elements of financial statements. Do you understand that? When they say line item means those items that must be under each of the elements of financial statements. You understand now? Under the asset now, we have the non-current asset and the current asset. So line items under the non-current asset, under the non-current asset include property, plant and equipment, intangible assets, goodwill, right of use of assets, and like that. The current asset we have receivable, inventories, cash and cash equivalent. You understand now? Just hold on. You will ask your question. After this, now I'll take time to answer questions. So you just mention it that way and then you move. You understand? Then I say state 5 items that should be accounted for instead of changes in equity. This one is very simple. Under the of changes in equity, what must be there? Your share capital must be there. Your share premium must be there.
Revaluation surplus.
Revaluation surplus must be there. Retained earning must be there. All of that thing again. So everything under equity that you have under equity in your financial position must be there. And then you have your 5 marks. And that is that for that. So let's look at the last one, November 2020, I think 2024. So explain the following basis of measurement. That's what we have just looked at now. 4 basis of this thing, you see. So you have historical cost, current cost, realizable value, present value. Can anyone attempt it? You can see it, right? Question 5. You see? Very simple question. So I'm begging you now. Don't joke with this particular grid. Questions comes from there almost every diet. Last diet, I didn't check. I've not checked that question to see, but I know 2025 2024 May did not ask any question much. But I know too well that this diet they will ask question on this regulatory and conceptual framework, which is under the grid A that we have looked at. Please, once you see them in the exam, those are the first questions that you should attempt. Don't ever start with attempting question 1. Go and start reading your question from question 7. And look at the key ones you can quickly do them and move ahead. So that is that for that. Any question? Any question? So now you can ask your questions, please, as we are concluding. Please, Ogunmoyede, you said you have question. Please ask your question.
Yes, sir. Good afternoon, sir. Sir, when you were answering the question for question 7, that they said the minimum line items that should be stated in the statement of financial position. When you're checking it, you said when we do the assets that we now write, okay, in assets we have PP and all that. But when we calculate it, I don't think it's up to 5. We have assets, we have liabilities, we have the equity. Are we going to put the assets in non-current assets and current assets, non-current liabilities and current liabilities, then equity? Even with it is still 4, but not up to 5. How will you be able to do it? Like,
I'm coming. Let me see. Set of financial position. Okay. Now this is what I'm trying to explain to you. Under that asset, the asset now, they say you should give example. So under asset now, you can write asset, write PPE, write intangible asset, write receivable, write inventory. That's 4 already now. And you can go to liability and write provision, payable, loans,
overdraft.
overdraft. You understand? They say give example.
So just the examples. Okay.
See, ICANN is wiser, and that's why you need to be more wiser. They know that a lot of you will go and write elements. Since they have said 5 now, you will go and write asset, liability. You will not say, I finished ICANN. You did not finish ICANN. They say give an example of minimum line items. Some of us will go and write asset, liability, expense, income, equity, because they say 5, and you know element is 5. You write it as element. I finish ICANN. They can't do me anything. I've finished it. It's a lie. You wrote the wrong thing. But when they say line items, what are the things? The things that you see in the center of financial position. They may decide to change this question to what are the line items in the statement of and the statement of profit or loss. And you have to also state it there. Yeah?
Okay, sir. So it's the same thing for that statement of changes in equity. That means you will not be giving those items instead of the examples.
It's those line items. Those are the key things that you have as the headlines there. That's what they are talking about there.
Okay, sir. Okay.
Okay. Any other question? I'm sure there's no other question.
Sir,
I hope I've been able to. Okay, Gane, go ahead.
Sir, I noticed one of the questions, the past questions that you just showed us now, that when we are asked to list the quantitative characteristics of the use of financial information in financial statements, I noticed that it was not, they just said we should list 5, but we are not told if it is the fundamental qualitative or the enhancing qualitative.
When they are silent,
you
can help them to. There are 2 ways to do it. Either you answer everything like that and give it to them like that, or you help them to identify the fundamental and the quality and the enhancing. You are right either way.
Okay, sir. Thank you, sir.
Right. I hope I've been able to add value and knowledge to us. Please, I'm begging you to start with material. Get your material today, please. Very, very important. Get your material today. The modality of payment will be shared on our WhatsApp platform. Get the material. Sit down with it again. There are a lot of questions in it, and I bet you can recap today, and then you are done with the grade A. Then you have BC and D to just look at. Thank you so much for your time. I really enjoyed the time with you. Please, my joy will be that I see all of you passing this exam. And we are going to have the lecture again, I think by tomorrow. Then we move to another grid entirely. Thank you so much for your time. Have a very wonderful day.
Thank you so much, sir.
Thank you, 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 sir. God bless you.
Thank you so much. God bless you.
Thank you, sir.
Thank you very much.
Thank you, sir.